Today's bond market looks very different from what it did just a few decades ago. Not only has the structure of the market evolved, but so has the role bonds play in portfolios. Trading is increasingly electronic, data is more abundant, and the number of bonds available to investors has grown dramatically. At the same time, the dynamics shaping returns have become more complex. With shifting inflation and policy regimes, the rise of the AI investment cycle, and an ever-evolving mix of risks and opportunities.
It's really about the transformation of systematic investing from what has historically been a breadth game, where you're doing a little bit of an edge across a lot of individual companies, to adding some of the depth that has historically been the purview of deep value fundamental investors. We can now systematize some of that depth approach with these new AI tools. And that's really the transformative thing that's happening on the horizon.
Welcome to The Bid, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Pulido. On this episode, we're taking a closer look at how bond markets have changed and what that means for investors. From the evolving role bonds play in portfolios to the expanding use of data and AI in investing, we'll examine today's fixed income landscape and the growing role of systematic, data-driven approaches within it. Joining me is Jeff Rosenberg, Senior Fixed Income Portfolio Manager for BlackRock Systematic. Jeff has watched these shifts unfold over the course of his career and is seeing how investors are adapting to a world where bonds may behave differently than they have in the past. Jeff, thank you so much for joining us on The Bid.
Oscar, great to be back on The Bid.
Well, Jeff, you're a bond investor, and you've had a front row seat to many of the transformative shifts that have been shaping the bond market recently. Maybe we can just take a step back, and when you think back to the start of your career or even earlier, what was different about the bond market then as compared to today?
Yeah, I like this question. My perspective goes back over 30 years, and you think about that history in terms of specific periods. And one period that we came out of was the post-GFC to the COVID period. We saw very low levels of inflation. We saw very strong levels of bond market diversification. So bonds really featured in portfolios as almost the perfect portfolio hedge. There was insurance where the premium paid you. You come out of the post-COVID environment and we've seen some dramatic shifts. Inflation is now too much inflation rather than too little inflation. And we're seeing positive stock-bond correlation. We've seen it in the 2022 environment. We've seen it recently coming out of the Iran war shock, that bonds aren't necessarily the hedge that they used to be. And it's forcing a whole rethink of the role of bonds in investors' portfolios.
And that's consistent with what Jean Boivin talked about in the 2026 BII Global Outlook, where he talks about a diversification mirage and that it's harder to diversify in today's environment. And as you're mentioning, bonds haven't played the traditional hedge role in a portfolio that maybe they did for much of the last 10, 15 years. So given that transformation, Jeff, and what's happened in bond markets, how are investors approaching their investments in bonds and the markets overall?
It's this movement away from the kind of traditional role of thinking about bonds in a portfolio from a total return investing perspective, and more towards thinking about bonds more from the specific outcomes that they can provide. And that range of outcomes can be income, which is their traditional role, or other specific outcomes. And it's really the shift in the conversation towards systematic investing where we bring in that approach where it's really about engineering for specific types of outcomes.
Jeff, I think there's a saying, bonds for ballast is often how people have thought about the role of bonds in their portfolio. I think what you're saying is that bonds may still play that role, but they can also play other roles as well.
Yeah, and it's not only just that the bonds are playing other roles, and the biggest one of that is going to be thinking about them more from income than from ballast, but also what we do in systematic investing in fixed income to use different techniques in the bond markets to deliver the more traditional outcomes, to bring back some of the ballast that the asset class kind of lost as a function of primarily the shift in the inflationary environment from too little to too much inflation. undermined the asset class characteristic, by using techniques like long short investing, you can kind of bring some of that ballast technique back, or ballast outcome, I should say, back to fixed income.
So far, it sounds like what you're describing is a transformation that has been driven by a change in the economic environment. You mentioned the GFC, the global financial crisis. Through COVID was a period of low inflation, low real interest rates. And now we've been in a different regime, and that's been part of the transformation. But let's talk about technology and AI, which presumably has had a transformative impact on the bond market. What are you seeing from that lens?
Let me talk a little bit about the what, the impact that it's had on the bond market, and then the how, which is how it's changing how we invest in bonds using AI and technology. So the first on the what, there's kind of two aspects. There's a macro aspect, and that is part of that kind of post-GFC to COVID environment was this period of very little or low investment demand relative to a lot of supply. And so the impact of that intersection between low demand and high supply was very low and even negative real interest rates. So you come out of the COVID period and you've got a lot of factors, but AI, we can clearly see, is this massive capital investment regime. And it's happening globally in terms of the scale of capital investment required. So that's shifting upward the demand for capital. It's happening in an environment of other factors as well that we used to talk about: globalization changes, reshoring, securing energy sources, partly driven by AI. All of this is shifting up the demand for capital. And that, from the bond market's perspective, is a huge impact with regards to what is the outlook for real interest rates. Real interest rates are low, but they're rising. And they're coming off this period of zero and negative levels to increasing levels. So that's kind of the big impact, because bond market investors' returns start with the real interest rate, especially when we think about the returns after inflation. So that's the macro piece. The micro piece is the AI story started with financing those capital requirements out of free cash flow. And the big shift over the last year has been, this is now a debt-financed exercise. And so the movement of AI into the debt markets to finance that expansion is bringing both opportunities and risks. The opportunities are, you've got more debt issuance across both the hyperscalers, the environment around that, the infrastructure build out. The risk side is you own some of that risk more in your bond portfolio. This was a bigger concern a few months ago. The concern has been overwhelmed by another risk, which is the disruption risk. And the disruption risk, best encapsulated by this tagline, AI eats software, is kind of a technological shock to the established business models of software as a service, which has been big issuers in the debt markets. And so that's creating sort of a repricing as we try to anticipate what is the impact of this transformational technology on the valuation and terminal value of many of these business models that are being disrupted. So you're seeing both sides of that in terms of the what side of the bond market.
So what you're saying, Jeff, is that the first impact that AI is having on the bond markets is you have companies that are at the center of the AI build-out that are now issuing more debt. This journey of capital expenditures that they were on initially was funded from just cash on the balance sheet, but now they're looking to the debt markets to finance that. And so that's one of the impacts that it's having on the bond markets, more supply of fixed income. But maybe talk a little bit about the how. How does this impact how bond investors like yourself approach the market?
Yeah, this is more about the tools and the techniques that are available to us. This is upgrading our toolkit. Now, in systematic fixed income, we've been using tools like AI before people talked about AI. But the AI that's captured our attention is the generative AI. It's the AI that you interact with. There was an earlier form of AI, predictive AI. BlackRock Systematic recently celebrated a 40-year anniversary. The fixed income side of that is celebrating over 20 years of applying tools like artificial intelligence and machine learning to the problems of fixed income. What the generative AI component of this transformative technology is doing is upgrading our toolkit. So you think about what we did before we had generative AI in things like sentiment analysis, using tools like natural language processing. They were very basic relative to the large language model approaches that we're now upgrading some of those sentiment tools to employ. What's the big difference? Natural language processing, pretty basic, coding specific words, ranking those words with a dictionary, wasn't context aware. The LLM approaches are much more context aware. And so they do a much better job in terms of delineating sentiment out of things like a language, earnings, transcripts, conference calls, on the micro side, on the macro side, central bank, text, speeches, and the like. So the upgrade to the toolkit is a big story for us in AI. But there's another story as well that's part of this transformative aspects of the modern bond market, and that is the impact of modernization, particularly within the credit markets. So the credit markets as a subcomponent of the broad bond markets. And this maybe, Oscar, is a whole other topic for another bid, which is really the role that bond market ETFs have played in transforming how price discovery happens within the bond market. It's a very interesting story, but the impact in terms of the combination of tools and the upgrading of tools that AI is delivering to investors, particularly systematic investors, and melding that with the changes that we've seen in how transactions and price discovery happens within the credit markets is creating what I call a Reese's peanut butter cup moment for systematic investing. What does that mean? It means two great tastes that go great together, chocolate and peanut butter. The chocolate is systematic investing is about the real-time processing using tools like AI and big data, updating optimal portfolios in small increments on nearly a real-time basis. That melds really nicely with the peanut butter of the modernization of credit market intermediation, where we trade less on individual large positions on big benchmark bonds and more on a portfolio-wide basis. That intersection is unlocking more alpha opportunities for investors approaching bond market and credit market portfolio management from a systematic perspective. So that's a way in which technological transformation we're seeing across a number of features, both the AI component in how we invest systematically, but also in terms of the technological advancements and the changes that the ETF revolution has brought about in terms of price discovery and how we do intermediation in the credit markets.
It sounds like technology is making investing in the bond market perhaps more convenient, or for you as an investor is giving you access to more opportunities and ways to generate return. And Jeff, just to go back to something you said, which is how AI is now, and generative AI is giving you more insight into the market. I suppose as a bond investor, you care a lot about what central banks are saying and the press releases and the statements from the heads of those central banks. So it sounds like not so long ago, you could read the transcripts from central banks and do maybe a word count, how many times they said a positive word versus a negative word. And that seemed pretty insightful at the time. But you're saying it's evolved even from there, where you now have a better way to gauge sentiment. Is that a good example of how AI is impacting your space?
It's a good example. It allows us to systematize what we've always done from a fundamental perspective. Now, the example of the Fed is a bad one because that is the most widely followed central bank in the world. There's a lot of depth. It's in the price. You're not going to get a lot of alpha and edge on that. Where you see it is doing that not just for the Fed, but doing it for all central banks and doing it across large markets and small markets where you can get some more alpha in the macro space. And then when it comes to this kind of sentiment analysis, it's really about doing it in 5,000, 10,000 individual companies where you're taking in not only information from the company, the earnings releases, the press conferences, but also from analyst reports, media coverage. It's really about the transformation of systematic investing from what has historically been a breadth game, where you're doing a little bit of an edge across a lot of individual companies, to adding, and this is really the change in what AI is bringing to systematic investing, is adding some of the depth that has historically been the purview of deep value fundamental investors. We can now systematize some of that depth approach with these new AI tools. And that's really the kind of transformative thing that's happening on the horizon.
So you've definitely highlighted a lot of transformations in the bond market. And I'm thinking there are investors who still remember buying a bond over the counter and holding it to maturity. And you've definitely painted a picture of a much more modern bond market and a much more modern approach that you're taking. If you look forward now, you've already painted a picture of a very futuristic scenario that we're living in today. But where's the bond market evolving from here? What do you see going forward?
We've touched on it a little bit, and it's really a combination of those 2 points. The tools allow greater depth in the analysis in a systematic way. So systematizing the depth of fundamental analysis that historically has been hard for systematic investors to penetrate. That's kind of one point. And then the second point, back to this modernization of bond markets, it's really about encoding that capability into our real-time portfolio optimization. So we've always had kind of transaction cost aware optimizations, but now you can make those optimizations liquidity aware. So you bring into your investment process the two sides of the equation, the real-time analysis of the large data across your portfolio, updating in small increments every single day in this kind of near real-time optimization, but then incorporating at the same time, what does the liquidity environment look like? But you're able to do that systematically because you have portfolio trading, you have greater electronification of credit trading, and moving away from your earlier kind of description of getting on the phone and trading that big benchmark issue, evaporating liquidity very quickly, having to work orders. That's the old style. The new style is finding ways to expand the amount of alpha extraction that we're able to generate by minimizing the transactions cost through these new ways of transacting.
I think when we think about the markets, we think about stocks, and there's literally thousands of stocks, right? But I think in the bond market, the number of unique issuers and bonds is actually an order of magnitude bigger. So it sounds like you need to use technology and some of the techniques that you're talking about to really find the opportunity. Is that a good way to think about it?
Yeah, it's a great way of thinking about it. And it's also a great way in which the combination of the transformative technologies and the change in bond market intermediation unlock more opportunity for alpha extraction. But you need to be able to minimize your transactions costs so that alpha isn't basically eaten up by your transactions costs.
Well, Jeff, you've taken us on quite a tour here. We talked about bond ETFs. We talked about AI, the companies that are issuing debt, but also how you're using AI and technology to invest in the bond market. This sounds like a space that is evolving quick. Thank you for shedding some light on this topic, and thank you for doing it here on The Bid.
Great to be here.
Thanks for listening to this episode of The Bid. Next week, we'll turn from bonds to stocks as we speak to Ibrahim Kanan about looking outside of the Magnificent Seven stocks that have been driving the biggest returns in indexes.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.